Then why don't you take that that new 2 trillion you created and issue some, a Judy Shelton's 50-year gold indexed whatever new debt, totally aside from, all the existing refunding and new issuance at the U.S. that the Treasury has to do. And then you take that $2.5 trillion and put it in your sovereign wealth fund. I don't know. Again, I'm just spitballing stuff. At the end of the day, it seems to be when they're talking about monetizing the asset side of the balance sheet, that's the most obvious thing that you could do. Whether you peg the gold to $2,900 market to market or 10,000 or 30,000 or whatever, I would think that'd have a positive impact on the actual gold price.
Gold prices surged to a new all-time high of $3,052 on Wednesday following the Federal Reserve's decision to keep interest rates unchanged. As Fed Chair Jerome Powell spoke, the precious metal briefly cleared the psychological $3,050 mark, though it struggled to gain enough momentum for a decisive move beyond this milestone. Despite this, gold's uptrend remains strong, with the potential to challenge the $3,100 level shortly. Market analyst CraigHemke of TF Metals Report suggests that another record-breaking high could be imminent as the next quarterly close in March approaches. Such a move would further reinforce the ongoing shift in the market, attracting increased institutional interest. The long-term trend for gold has been overwhelmingly positive, with its price increasing tenfold since the start of the century. Much of this demand has been driven by large-scale buying from countries in the global south, signaling a decline in the dominance of the U.S. dollar. Russia has also significantly expanded its gold reserves, reaching a record $217.4 billion as of March 1, 2025. This makes it the fifth largest holder of gold globally, surpassing China. Gold now comprises 34.4% of its total foreign exchange reserves. According to the RBC News website, the Central Bank of Russia remains focused on gold accumulation, aligning with a broader global trend of central banks turning to precious metals for financial stability. The World Gold Council reported that global gold demand reached an all-time high of 4,900 tons in 2024. Gold's price shattered records 40 times throughout the year, rising by 27%. Hemke emphasizes that while individual traders may be caught up in short-term price movements, institutional investors focus on the bigger picture, and that picture continues to look increasingly bullish for gold and mining stocks. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Really big money, the stuff that really moves the market. Not just central bank demand, large institutions and hedge funds and the really big family offices. They're looking for secular, big, long-term trends. Mm-hmm. So they're not looking at the hourly chart, and they're really not even looking at the daily chart or the weekly chart. It's the monthly chart. It's the quarterly chart. It's even the annual chart that lays out how things are shifting and where they want to start moving into, one sector versus the other. Go all the way back to last year. Gold this time last year just barely begun to break out on March the 1st. It had gone up to about $2,000, a little bit above at 1st of December of 2023, and then was going sideways. But as it broke out in March, not only did it paint a new monthly high on the monthly chart, paint a new high on the quarterly chart as well. And then what'd you see? Then you see it begin to accelerate, and demand for gold in all its forms begin to accelerate from all of these really deep pocketed, we're talking, like I said, institutions and really big hedge funds and the like see that trend. And that's what they're watching. This next quarterly close for this March coming up in 3 weeks. We could variously paint another new monthly all-time high, another new quarterly all-time high. And that's the sort of thing, again, that's like, okay, there's really something going on here. Not so much the noise of the daily chart. And just to relate this one back to the mining shares, or the stock market in general. Mm-hmm. You could say that, again, that same big money is so focused on growth. And it has been a growth-driven market now, really, for over a decade. The Mag 7 and all that kind of stuff, and AI or whatever is the theme of the day. That value has been, a high dividend and all that stuff has been left behind. Big gold mining stocks that pay a 4% dividend and trade at a 10 PE, that's a value stock, Tom. Mm-hmm. And maybe that's what we need, is that secular trend pullback in growth and a rotation more toward value, that would benefit the mining shares too. So again, it's these big, large trends that if you're investing billions of dollars, not just, a couple of thousand, that's the kind of stuff you got to get right. That's the stuff you pay attention to. And that's where, again, they focus more on the bigger picture, where it's so easy for me in particular. I'm on X, I'm looking at headlines, I'm looking at the chart, oh, look at that, look at what's happening today. When the big picture stuff is very, very positive. I have no idea. We're talking about things that have never happened before in our lifetime, right? The last time gold was revalued was what, the 1930s? So, even if, and I can make a case where they decide that gold is worth, let's say, $10,000 and put that on the asset side of the balance sheet and mark it at $10,000 up from 42.22. That doesn't mean, I don't know, maybe that means gold trades at $10,000, but it doesn't guarantee it's going to trade at $10,000. I mean, if the government says we are a buyer of gold at $10,000, okay, well, maybe that would have a bigger impact. But that doesn't mean that you can go into your local coin shop with a gold eagle and they're going to give you $10,000 for it. So what we're talking about here, and where all the speculation has been, is this monetizing the asset side of the balance sheet.
The valuation of the United States gold reserves remains a point of debate, with calls growing for an audit of holdings at Fort Knox and other storage sites. Despite gold trading at approximately $3,050 per ounce, the U.S. government continues to value its 8,133 tons of reserves at the outdated 1973 rate of $42.22 per troy ounce. Treasury Secretary Scott Bessent clarified during a recent appearance on the All In podcast that no such move is planned. While acknowledging the idea's popularity among gold advocates, Bessent emphasized that the government is instead focused on mobilizing other assets. This approach aims to generate financial resources without resorting to revaluing gold to help offset Washington's $36.2 trillion debt. The disconnect between gold's official valuation and market price remains a concern. Analyst CraigHemke highlights that while central banks carry gold at a fraction of its actual worth, its true market value is far higher. Some have speculated that revaluing gold to $10,000 per ounce could unlock economic potential, but the outcome remains uncertain. Such a move could generate enthusiasm or lead to disappointment if prices do not react as expected. Let's get back to the interview.
They carry it now at $42.22. That doesn't mean gold's trading at $42.22. It's trading at $2,900.
Yeah.
So if they carried it, at $10,000, what does that mean? I don't know. I don't know. I mean, it could be the biggest disappointment of all time. Gold goes down, gold opens up the next day down $50. Would that surprise anybody? It will be interesting to see how it works out. I have thought, it dawned on me in the middle of January. I was in the middle of recording a podcast for my site with Andrew McGuire, and I was asking him about all this gold that was, the spread that had opened up, spot versus futures, and why that would be, why nobody was arbitraging it, and the lack of confidence in executing that trade was why that had widened out so much. And we're starting to see these deliveries surging in New York and all this kind of stuff. And it dawned on me, I thought, they're using the tariffs as a cover for all this. I thought, what if they're just out of gold, Tom? The article came out from the Financial Times that really kind of lit a fire back in early February. They said that you got a 4 to 8 week delay to take delivery in London, not 2 to 3 days or 4 to 8 days, 4 to 8 weeks. And I've yet to see where, now it's back to, 4 days. Well, 4 to 8 weeks to just simply move some gold out of here, across the line or onto a truck or something. It's starting to make me think, well, maybe they're out. Maybe 31 or 3,200 metric tons of net central bank demand over the last 3 years. Maybe it cleaned them out. Well, what does that do to everything then? I mean, that's a more tangible thing than just this monetizing the asset side of the balance sheet thing. Global gold market is underpinned by our, whatever it is, 8,300 metric tons of gold that we have in our vaults. Well, like 4,500 of those metric tons are the Bank of England's gold. Is that for sale? I don't think it is.
Yeah,
maybe it is.
Where's the clarification in that?
Yeah. Another big, 3,000 some odd metric tons is the gold for the big ETFs like the GLD that's custodian there. That shouldn't be for sale. Okay, so what's left over? Ronan Manley did a thing, said it's only about 700 or 800 metric tons, and that was like 5 or 6 years ago. Mm-hmm. So all of a sudden, there's 3,200 metric tons of demand for 3 years from just central banks. At the same time, all of a sudden, the LBMA says, you got to wait 4 to 8 weeks to get you. Remember Germany, when Germany tried to get their gold out 10 years ago? And they said, we'll get it to you over the next 4 or 5 years. Mm-hmm. And then when they finally started getting some gold, it was like not the gold that they deposited. It was like, some brand new bars and some coin melt bars and all this kind of stuff. Maybe a more interesting story is not so much, what's Trump going to do and what's the US going to do as a market. What happens to this whole kind of fractional reserve pricing scheme if the leverage is getting so stretched that the LBMA can't deliver gold in less than 2 months? Again, very interesting times that we live in, Tom.
As gold continues its record-breaking ascent, the dynamics of global finance are shifting. With central banks increasing their holdings and geopolitical uncertainty fueling demand, the precious metal remains a cornerstone of economic security. Meanwhile, debates over the accurate valuation of U.S. gold reserves highlight the complexities of monetary policy in an era of rising debt. Whether gold will see further price revaluation or remain under its historical pricing model is a question that could shape future financial strategies. Could a formal revaluation of gold reserves reshape the global monetary system, or will market forces continue to dictate its true worth? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.